The AI industry spent 2 years telling you that scale was everything. More parameters, more chips, more spend. This week, that story cracked in at least 3 separate places simultaneously. OpenAI's IPO reportedly hit a delay. Korean chipmakers fell 6% in a single session. And new research is now directly challenging the assumptions that justified hundreds of billions in infrastructure investment. The question you should be asking is not whether AI is real. It obviously is. The question is whether the economic model that Wall Street has been pricing for the last 2 years is the one that actually survives. Start with the most market-moving headline from today. Reports emerged that OpenAI's IPO timeline has been pushed back. And that single item was enough to drag the Dow, the S&P 500, and the NASDAQ lower. That reaction tells you something precise. A meaningful portion of the current tech rally is priced on the anticipation of OpenAI going public, not on the fundamentals of companies already trading. Why would an IPO delay rattle the broader market? Because OpenAI has functioned as a kind of conceptual anchor for AI valuations. If OpenAI is worth X at IPO, then every AI-adjacent company, the chip suppliers, the cloud providers, the enterprise software integrators, can triangulate their own multiples off that reference point. Remove the anchor, and those valuations float in less certain water. Now, to be precise about what we know and what we don't, the headlines confirm the reported delay and the market reaction. They do not tell us the specific reason for the delay. But the timing matters. This is not a delay happening in a vacuum. It is happening at the same moment that new research is surfacing to challenge the scaling narrative. And at the same moment, Anthropic is managing its own reputational turbulence around the mythos situation. When multiple signals break in the same direction at the same time, that is worth paying attention to. The actionable insight here is not to panic sell AI exposure. It is to ask a more precise question. Which companies in your portfolio are priced on the assumption that AI revenue scales linearly with compute spend? Because that assumption is the one now under examination. Business Insider reports that new research is challenging nearly every major AI narrative of 2026. That framing is significant. Not one narrative, nearly every major one. The specific research details were not disclosed in the headline, so we are going to treat this carefully and analytically, rather than invent specifics that are not yet public. Here is what we can reason through. The dominant narratives of AI in 2026 have centered on a few core claims: that larger models consistently outperform smaller ones, that token volume and compute spend translate directly into capability gains, and that the companies with the most infrastructure investment have a durable moat. All 3 of these are efficiency questions at their core. What has actually happened in practice over the last 18 months is that smaller, more efficient models have begun to close the performance gap with frontier models in specific task categories. Enterprises deploying AI at scale have started optimizing for cost per useful output, rather than raw benchmark scores. The industry term that has emerged for the old approach, token maxing, is being quietly replaced in technical circles with a focus on inference efficiency and architectural optimization. This shift has real capital implications. If the return on incremental compute investment is declining, the investment thesis for companies whose entire value proposition is selling more compute becomes structurally weaker. It does not mean those companies collapse. It means the rate of growth that justified their current multiples needs to be revised. The actionable insight? Differentiate between AI companies that profit from scale and those that profit from capability. Those are not the same thing, and 2026 may be the year the market is forced to price the difference. Pull back to the hardware layer, because 2 separate data points today are telling a coherent story. Korean stocks fell 6%, led by chipmakers, in what Bloomberg described as a renewed sell-off. Separately, CNBC reports that rising memory chip costs are now putting pressure on retailers selling laptops and smartphones. These look like two different stories. They are actually one. The AI infrastructure build-out created enormous demand for specific categories of chips, primarily high-bandwidth memory and advanced logic chips. That demand spike pulled manufacturing capacity toward data center applications and away from consumer hardware. The result is a cost pressure that is now working its way through the consumer electronics supply chain. Retailers are absorbing margin pressure, or passing it to consumers, or both. The Korean market reaction is worth unpacking further. South Korea's semiconductor industry, particularly companies in the memory space, had been a direct beneficiary of AI infrastructure spending. A 6% single-session decline suggests the market is repricing the sustainability of that demand trajectory. Whether that repricing is an overcorrection or a reasonable adjustment is genuinely uncertain. What is not uncertain is that the market is asking the question in real time. On top of this, Anthropic is managing fallout from what The Verge is calling a worsening situation around Mythos, though the specific details of that situation were not available in today's headlines. What we can observe is the pattern. The two leading AI labs are both absorbing negative headlines on the same news cycle. That is not coincidence. That is a sector under pressure to justify its own narrative. The actionable insight, memory chip exposure, both on the supply and retail side, is now a two-sided risk. The demand that justified the build-out is being questioned at the same moment that build-out costs are pressuring consumer hardware margins. That is a squeeze worth modeling before it becomes consensus. And, as always, none of this is financial advice. It is a framework for asking better questions with your own capital. We opened with a simple observation. Scale was supposed to be the answer, and this week, 3 separate data points challenged that in the same news cycle. The IPO anchor lifted, the efficiency research surfaced, and the hardware costs started bleeding into consumer margins. The open question, and the one we are going to dig into next, is which AI business models actually survive an efficiency-first world? If that question matters to you, subscribe. You will not want to miss what we cover next.